Good morning, welcome to Access Middle East. Dan Murphy with you in Dubai. Straight to your top stories this hour. First today, oil prices climbing after Reuters reports the US has banned Chevron from exporting crude from Venezuela. We'll discuss. Meanwhile, all eyes are on OPEC, with the producer group potentially ramping up output hikes this weekend. The UAE's energy minister weighing in, saying there's still a need for more energy investments.
Rest assured, this group is doing its best, but it's not enough only this group. We need the help of the others, and we need to be mindful of the demand. Demand is picking up.
And Access Middle East is going all in. We'll speak with angel investor and podcast host Jason Calacanis and hear what he likes in the Gulf. That's coming up. Good morning. Busy show ahead for you. Let's dive straight in. First to what's moving in the Asia markets here, and regional stocks have been climbing today. Look, the session, you could say, looking a little better than it was yesterday. Wall Street also moving higher on Trump's EU tariff delay. But we are seeing China stocks down for a fifth straight session earlier in the day. So a slight recovery there for the mainland, still better by 0.07% there, just above the flat line. Hong Kong's Hang Seng down by around 0.5%. The Nifty 50 in India down by 0.23. Our top gainer today is the Kospi, better by 1.75%. Of course, oil very much in focus this week. A check on prices for you here now. Just want to note that prices in Asia trade saw some support after the US granted limited clearance for Chevron to keep hold of its Venezuelan assets, even in light of the Trump administration's sanctions on the country. However, Chevron now cannot export oil from Venezuela, which will push total global supply lower. We're going to be unpacking this with our guests later on in the program. And of course, we are also awaiting OPEC's meeting today. The 22-member group will review the market, but no change to policy is expected, at least for now. OPEC Plus are expected to agree to an output hike for July when the 8 members, led by Saudi Arabia, meet on Saturday, though. OPEC and its allies have agreed to 3 layers of output cuts since 2022, 2 of which are in place until next year. Members began unwinding the most recent layer in April, and for May and June made larger than expected output hikes of 411,000 barrels per day. Abu Dhabi weighing in ahead of the OPEC Plus meeting this weekend. As I mentioned, OPEC Plus has already delivered 2 back-to-back output increases for May and June. Reports now suggest the group is discussing a 3rd straight hike for July. Of course, we have also heard conflicting reports suggesting that the conversation hasn't even started yet. I said earlier that one option on the table is another 411,000 barrel per day boost, according to reports, but of course, that remains to be seen. The UAE energy minister told me the group is trying to strike a balance between supply and demand, and said that OPEC Plus cannot shoulder the burden alone. Listen in.
Let's look at the future demand. I mentioned in my speech that there will be more demand on electricity. Now, I'm hopeful on the converting solar to base load. I'm hoping in more renewable energy. But at the same time, we need base. Otherwise, we cannot afford to have incidents like the one in Europe where 2 countries were cut. That inconvenience in Spain and Portugal was shocking. And you don't want to see that replicating in other parts of the world. Therefore, here in the UAE, and I think a wise system is saying you need a diversified supply, and you need to have enough adequate supply of hydrocarbon during the transition to transit. If you don't do that, then you will be surprised. The prices will be so expensive, and people will not be happy. At the end of the day, I think the administration in the US and us here, we're looking at the demand side. We are looking at the consumers. Can we make sure that we don't have that shock? And you cannot avoid that shock if you're not investing and drilling while you are doing more in renewable energy than others. So it's a balance.
Final question on this. What is the message to the market as OPEC deliberates plans for output come July?
Well, I think this group, that is OPEC Plus, I would say, are doing their best to balance the market and ensure that we have enough investments in the supply. If this group was not there, there will be a chaos. This group was not doing the sacrifices, especially the group of 8, the sacrifices that they did. We will not have a balance in this market, and you will be seeing shocks, and that is not a good news for the consumers. So rest assured, this group is doing its best, but it's not enough only this group. We need the help of the others, and we need to be mindful of the demand. Demand is picking up, and demand is going to surprise us if we're not investing enough.
The UAE Energy Minister there speaking to me yesterday on stage at the World Utilities Congress in Abu Dhabi. For more on this, let's turn now to Arne Lohmann Rasmussen. He is Chief Analyst and Head of Research at Global Risk Management, joining us live from Copenhagen. Arne, welcome to the program. Great to see you there. So first of all, I want your reaction to what you just heard from the UAE Energy Minister. Of course, we have seen a series of output hikes from OPEC already. What do you think is going to happen next?
I think it's pretty obvious that this is going to continue on Saturday, and I guess we might get some clear indication today at the sort of big OPEC Plus meeting before the V8 on Saturday. But it seems like another 400 or 11,000 barrels is coming to the market. I'm probably a bit more cautious, saying that the market is balanced. It might be balanced today, but if we look 3, 4, 5 months ahead, I think they are playing a bit with fire now if they want to keep a stable oil price. It seems like we are heading for an oversupply later in the year.
Can the market really absorb another 411,000 barrels if OPEC does indeed go ahead with this new output increase? We're already seeing prices stuck at around $65 a barrel. That's below break-even for big states like Saudi Arabia, and also below break-even for some parts of US shale.
Yeah, sure, but I think that's part of the sort of already stabilizing the market, that especially this is biting into the US production. It's probably not going to grow much with WTI close to 60, so that, I guess that is stabilizing the market. And then, of course, we have all the talk about sanctions in the market. You mentioned in your own program the Venezuela. There's, of course, part of the sanctions. Iran is, of course, the big elephant in the room here. And it seems like almost by the day there's one day it's going to be maximum pressure. Next day there's a big deal coming. I don't know where that is ending, but I think in the sort of behind closed door, there's probably some understanding among the rest of the, especially the V8, that the sanctions on Iran that are probably going to continue in some way are giving some leeway for OPEC Plus to add more, or for the V8 to add more oil back to the market. And then, of course, we have Russia in the background. A lot of talk about could the U.S. lift sanctions. The last couple of days has moved a bit in the other direction. Could Trump sort of put more sanctions on Russia? But maybe Russia is not that important, because Russia is basically capped by the OPEC Plus membership, and I don't see them breaking that. But of course, one of the big sort of uncertainties is, of course, how the global economy will fare over the summer, going into the autumn, going back to the start of April, the Liberation Day with Trump in the Rose Garden. Of course, a lot of concern that this will end in a U.S. recession. It seems like probably going to be a more smooth sailing now. We'll probably avoid a U.S. recession. China might start to pick up a bit again. We're heading for the summer, more crude oil burn, product burn, fuel oil burn in the Middle East due to air conditioning and so on. So a bit more balanced market. So I think in the short term, the market will probably absorb this, and I think it's already priced in that there will be another 400,000 barrels of oil coming July 1st. We also see it in the curve. It is probably what you call backwardated in the very front end of the curve. It is normally a sign that sort of the spot market is supported. there is actually less inventories out there than people may think.
So, Arne, is this also about firming up discipline within OPEC Plus when you take a step back here and look at the broader strategy?
Yeah. I think that's basically a few strategies you can point to. One is, of course, internal compliance, and of course, everyone points their fingers at Kazakhstan and Iraq. So that's an internal market share war, so to speak. But I can't help thinking this is also about maybe let's take advantage of an uncertain investment climate in the U.S., high prices for steel imports for U.S. producers, interest rates staying at 5%. So maybe we can also take some market share from the U.S. So that's sort of the price war or market share strategy direction here. And then finally, of course, also everyone wants to be on a good footing with Trump. I guess that is no secret. And we all know that Trump has been sort of talking about that he would favor oil at 50. He may not get 50, but at least he gets this mid-low 60s. So I think it's like three things in one go: internal market share war with the quota cheaters, some market share war with the U.S., and then also being on a good footing with the U.S. And Trump. Of course, this comes 1 week after Trump toured the Middle East.
Indeed. So walk me through what the strategy looks like moving forward here, because I think it's also fair to say these Gulf producers are not going to tolerate lower for longer prices, at least in the very long term here. How long are they going to be able to maintain this discipline here and actually accept lower prices, lower revenues, and the budget impact that brings?
I think, as you said, this is actually hurting also in the Saudis. If we ask the IMF, they say that the fiscal break-even is probably somewhere between around $90 for the Saudis, probably a bit lower in the UAE. So this is hurting. But I don't think they have any. The OPEC doesn't have that much options here, because if they go back really pushing prices towards, let's say, 100, they will have another few years with a boom in non-OPEC production. We're not just talking about the U.S., Guyana, Brazil, Canada. So it's a balancing act. But I think when we pass the summer and we're looking into the lower seasonal demand in the autumn, I think we will be going back to production increases in smaller steps. We might even see a pause. I think that's quite likely if we see Brent dipping below 60 for an extended period of time. And then you can also say that then the big countries, the big producers who have had a high compliance in this, they are sort of have regained their market share from the cheaters, and then they can go back to a more stable production path in the autumn. But for now, they are sort of rebalancing the shares internally in the OPEC Plus cartel. So that's where we stand. But I don't think they will continue adding at this pace. Maybe again in August, and then that's it. But no doubt there is a plan to add these 2.2 million barrels back to the market, and it's been faster than that. But beyond that, I don't think there's coming more OPEC Plus oil for the time being. As you said, we have these three layers, quite a difficult setup here. But the first layer is now being unwound. I don't think we're talking about moving into the first and the second layer of production cut. That's far out in the future. But if we can avoid a global recession, if we get a sort of more calm in financial market, which it seems to be now, I do believe that oil will probably stay in this mid-60s, maybe towards the 70s when we are heading beyond the summer, going into the autumn. But it does sort of mean that OPEC will probably have to stop adding more oil by September.
Okay, just before I let you go, going back to my conversation with the UAE energy minister, I think he really enjoyed this conversation. It was the first time that he actually took a question on oil in more than a year. And of course, his comments are really critical here, given the UAE's role and priority inside the OPEC group. Just going back to what he said about demand as well, and you touched on this, but he spoke about what a surprise on demand could look like and said that OPEC is going to have to be prepared for that. So clearly, there are still bulls within the group who think that maybe prices are not matching fundamentals and that we will see a demand spike perhaps through the summer, perhaps through the second half of the year. Just weigh in on that for me. What do you think a demand surprise might actually look like?
We actually do see some, you can call it pocket of strength in the oil market. I'm part of a group where we supply bunker fuel for the shipping industry. We're the biggest supplier in the world of that. And we actually see strong demand for what you call high sulfur fuel oil, which is a residual oil. It's a small part of the market, but that market is actually very, very strong. There's certainly a strong demand there. We are going into the summer. There will be some more use of both residual oil, but also crude oil for power generation in the Middle East. And then, as I mentioned, a lot of people have probably become a bit too negative on the global economy, saying that okay, this can only end in tears and recession. It might not be that bad. But do remember, when we are past the summer, when we're heading for the winter, we're going into sort of low seasonal demand, and non-OPEC production is also growing, and there is a surge in renewables, as I think he also mentioned, both in Europe, Middle East, and especially in China. And then we were looking at India. How strong is India going to be? And then, of course, but that is less on the demand side, I would say. Well, of course, on the supply side, that is the sanctions that are the big elephant in the room here. But yes, there will be some demand, but I would not be too optimistic on that side.
Okay, we'll leave it there. Appreciate the conversation. Thanks for coming on today and weighing in. Loman Rasmussen there from Global Risk Management. Up next on the program, we are zooming in on the UAE's first gaming resort, set to open in 2027. We'll tell you what it will mean for the local economy and the UAE's hot real estate market. That's next. Access Middle East, back in 2 minutes. Welcome back. The UAE's first gaming resort, yes, gaming, expected to open in 2027. The $5.1 billion Wynn Resort, which is said to be bigger than the original in Las Vegas, secured the country's first gaming license from UAE authorities last year. It is the country's first casino, quote unquote, set to boost tourism to the emirate of Ras Al Khaimah, which sits just over an hour northeast of Dubai, the UAE's bustling tourism hub. Now, property prices there have been popping. So is this speculation or a genuine next wave of growth that we're seeing in the UAE? Christopher Hewitt is here. He is Senior Vice President and Head of Hospitality at Al Hamra. Christopher, great to have you and welcome to the program. We've been looking forward to unpacking the story in Ras Al Khaimah. It's certainly generating a lot of interest on the ground, not just in the UAE, but internationally as well. So let's dive straight in. First, I wanted to ask you about the Wynn effect, because that's what's driving all of this. Property prices up 128% on some of these branded residences alone since the Wynn Resort was announced. So what's happening out there? Is this real demand or is it a speculative bubble waiting to pop? Good morning to you, sir.
Good morning, Dan. Thank you very much for having me. Now, listen, it is not a speculative bubble. You know, there are strong fundamentals in Ras Al Khaimah's residential and real estate market. And what we've seen in the last couple of years in terms of its growth is really on the back of what is a strong tourism and real estate market. You know, if you look at the tourism sector, we saw an increase in international visitation to record levels at 1.28 million visitors last year. And we see that with the introduction of the Wynn Al Marjan Island and as well as other tourism and hospitality projects, taking that number to roughly 3.3 million by 2027. So fundamentally, this is not speculative. This is real demand, real growth. If you look at Ras Al Khaimah's GDP, it grew at 6.7% last year, and that's going to continue at roughly about 6.1% according to Fitch. And with a stable economic outlook, very good, strong governance and fiscal prudence, you know, Ras Al Khaimah is really on the edge of what we see to be a new renaissance period within the emirate.
A renaissance period. You know, Christopher, gaming, casinos, gambling, still a pretty controversial topic in this part of the world. Obviously, the Wynn Resort announcement and this development that we're seeing in Ras Al Khaimah doesn't sit comfortably with everyone. What are we going to see unfold here? Is this the beginning of Las Vegas in the Gulf?
No, I don't think so. It's all about entertainment and how do you provide a range of different leisure attractions for visitors in Ras Al Khaimah. So Ras Al Khaimah has always been known as the nature emirate. We've always been preferred as that staycation destination in the UAE, and we are seeing a lot of international visitation coming in from key markets within Europe, within Russia and CIS, as well as Africa and Asia. See, Ras Al Khaimah is not just about gaming. There's more to Ras Al Khaimah than the Wynn, and what we're seeing is a real growth in tourism across the entire spectrum within the emirate.
You're there in Singapore at the moment, and what you've also identified is that not just in Singapore, but increasingly internationally, there's high net worth and ultra high net worth individuals who are looking at the property market in the UAE. They're looking at this significant development that's been happening in this part of the world over the last couple of years. And I'm wondering how Al Hamra is actually responding to that. Can you genuinely offer something that will be able to compete with Dubai, which has such a stronghold in the UAE, being a tourism, travel, and major financial hub? How do you differentiate the offering here for these people who have capital that they can deploy quite literally anywhere?
So I think the value proposition in Ras Al Khaimah is slightly different from what you see within Dubai and other emirates within the UAE. We're really focused on lifestyle. And our residential projects are covering a broad spectrum of different real estate offerings, from premium lifestyle to luxury branded residential units, which are incorporated within some of our award-winning hotels. Lifestyle is a real key part of what ultra high net worths are looking for, where they don't necessarily want to be within a strong urban environment, but want to be in more of a resort living style of environment. So speaking to investors here within Asia itself and overseas, they are really focusing on something that they can get that is different from what you can find in other emirates. And I think what we are developing and what we're offering in Ras Al Khaimah is certainly ticking the boxes for these ultra high net worth individuals.
And of course, the development story has only really just started. The pipeline of openings is set to continue. Christopher, walk me through the bottlenecks that you're seeing right now. Is it land? Is it approvals? Is it talent? Is it something else that is ultimately slowing down delivery at this point? And if you were to look into the crystal ball here and put a final date on when you think Ras Al Khaimah will be hitting its stride and really taking tourism away from Dubai, then when would that be?
Well, I don't think there's so many bottlenecks to say. You know, we've got a very open and very transparent legislative and also approval process for new development. You know, just to give you a context, so Al Hamra has been at the forefront and really at the backbone of development in Ras Al Khaimah over the last 25 years. And over that time, we've developed about 4,500 homes to Ras Al Khaimah. And with the growth of population that what we are expecting in the Emirate over the next 5 years, we've now put in place a pipeline of another 4,000 units that will be delivered within 3 years. We see that the demand for high quality premium lifestyle residential is really at the backbone of what Ras Al Khaimah's growth is going to be about. So we're really focusing on delivering those to the highest caliber and delivering them quickly to the market to fulfill what we see as a gap and also a shortfall in residential supply.
Okay, so what would you say is the biggest risk moving forward as you undertake what is probably considered internationally quite a high-risk strategy here?
Well, I don't necessarily believe it is high-risk strategy. You know, the fundamentals of the real estate sector are strong. As you rightly mentioned earlier, there has been a very strong increase in property values. Last year, there was a significant increase in real estate transactions across Ras Al Khaimah, which grew significantly from the previous year. And there is a large number of investors who are entering into the market, whether it is buying land plots and developing those as investment products or government-led investments that are building these real estate projects. So really, I think it's more about increasing the visibility and the awareness of Ras Al Khaimah, which is going to be the one that drives this market further.
Okay, we'll be watching it really closely. I have to get out there myself personally to take a look. Christopher, looking forward to speaking again soon. Christopher Hewitt there from Al Hamra, live for us in Singapore. Stay with us on the program. We are back in 2 minutes. Welcome back. President Trump's visit to the Gulf last week was historic, and not just in terms of investment. Escorts of fighter jets, a fleet of Tesla Cybertrucks, royal camels and Arabian horses all rolled out to welcome the US president. He stopped in Riyadh, Doha and Abu Dhabi, securing investment deals in each Gulf state. Saudi Arabia reiterated a $600 billion pledge. Qatar offered Trump not only a new Air Force One, but an economic exchange worth at least $1.2 trillion US dollars, according to a fact sheet released by the White House. And in the UAE, the country is set to construct the largest AI campus outside of the US, reportedly securing access to 500,000 cutting-edge chips from NVIDIA. The UAE also pledging to invest $1.4 trillion USD in the US over the next decade. I spoke to the UAE's Minister of Energy about that visit and the partnership between the United States and the Emirates. Listen in.
I think we are very excited for this partnership. This partnership, one, in the AI sphere, is going to transform the UAE and enable it to serve so many nations. And energy efficiency and energy management is one of those beneficiaries sectors that can benefit from a gigantic data center. We can manage cities from Abu Dhabi and reduce the energy consumption because we can have that access and manage the building much better than human managing it. So this partnership is only positive for the region, for the world, and it's going to transfer UAE from an energy hub to an smart energy solutions cluster that serves its neighbors and serve the world. And we can also, as we are a major investor in the infrastructure, we can play a key role in modernizing the energy sector in the US. We already announced a commitment before, or a target for that 100 gigawatt of joint solar between UAE and the US. Imagine what can we do together if there are projects and they are viable. The US is a very attractive environment for investments, and we've been investing there. I don't see any problem for us expanding and investing there, as we are investing in the world as well.
The UAE Energy Minister weighing in on the Trump visit. And for more on this, let's turn now to Jason Calacanis. He is General Partner at Launch and also the host of the All In podcast. He's joining us live from Singapore. He's there for the Citi Singapore Macro and Pan-Asia Investor Conference. JCal, welcome back to CNBC. Good to see you, sir. So, look, first of all, just give me your read on the ground there in Singapore. And are they as bullish in Southeast Asia as they are here in the Gulf about the investment opportunities coming out of the Trump administration today?
Yeah, I think people are pretty excited about the fact that we have a president who is super engaged with the business community, putting aside the tariffs and a little bit of chaos over there. The fact that Trump has embraced the leaders in technology in America and has been doing these road shows where he brings American entrepreneurs and companies to the region. I think that's a pretty bullish sign that America is open for business and wants to do partnerships, which you could juxtapose with, say, China, which has essentially killed investment in the country from outside investors.
JCal, just walk me through your read on the markets right now as well. Obviously, this has not been such smooth sailing, but the markets do like the idea that Trump's trade war is winding down. What's your view? Is the Sell America trade over?
Yeah, I wonder if there ever was the intention to have a trade war or just have reciprocity and maybe level that out. I think the markets are pricing in that we'll have reciprocity, which seems fair to me, with different countries who want to sell into the U.S. market. Maybe that's long overdue. And Trump has a unique, effervescent way of communicating what his goals are. He tends to shake the snow globe, as it were. But I think we'll wind up with 10, 15, 20%, or just reciprocity, and everyone will get back to business.
Do you think markets might be overestimating just how permanent any of this trade de-escalation really is, though? Obviously, the headlines today are positive on US-China, positive US-EU, but how many times can Trump actually play this card where he announces something huge and then scales it back, markets pop, but then it doesn't really stay long-term?
Well, he's been doing it his whole career, so I suppose he'll do it indefinitely, and the markets just have to get used to it. And I think that's the reality on the ground. There is a backstop against Trump doing anything too radical, which is he really likes to be popular, he likes to be loved, and he really loves to have the economy in America roaring. Those are the things that drive him. And the markets have told him to maybe slow his roll a little bit, maybe communicate a little bit better. And I think the administration is reading that loud and clear. And businesses really need the ability to plan. I invest at our firm in 100 new companies a year. Now, small companies are figuring it out, getting product market fit. But as they get a little bit bigger and they start investing millions of dollars, then tens of millions of dollars in their plans, they need it to be predictable, whether it's hiring people overseas or importing products, supply chain. And so the community has called him on the phone in the administration and said, this needs to be more predictable and stop shaking the snow globe a little bit. And I think they've got that message, and now they want to do deals. So I'm extremely bullish on the market and where we're going. I'm not happy about the spending in the United States and the debt. But again, Trump seems to start with something pretty bombastic and then come back to something quite reasonable. And I think that's what we'll see as well with the budget in the United States.
You mentioned spending and the debt. Let's talk about it because, of course, Elon has also gone back to work now. Trump's new bill pushes forward these tax cuts that he's been talking about, but also new spending. So do you think markets might have lost faith now in the Doge agenda? And speaking of the deficit, can the president really keep extending the US debt burden in this environment?
I think we've got maybe 3 or 4 years of adding $2 trillion to the national debt before it blows up in our lap. I think a lot of people realize that Washington is, an imperfect place, and how our government works in the United States is quite dysfunctional. What we need right now is a profile in courage from President Trump, who says to the Republicans and the Democrats, we have to balance the budget. We cannot add to the debt. And he's been championing this bill. I think he needs to come out and say, do better. Cut some spending here. I am also of the belief that maybe we don't need to cut taxes too radically, and we need a little austerity in America before the markets force austerity on us. And just like any person who runs a major deficit in their household, our government is running too large of a deficit. It's time for a little bit of austerity in America.
Okay, so looking out to see exactly what happens next there on the fiscal side. J-Cal, on another issue, I wanted to ask you about the entanglement that we see between this administration and the crypto space. I know it's something that you follow really closely. What do you make of this headline today? Trump media set to raise $2.5 billion to invest in Bitcoin. This is a business that made $3.6 million last year. $2.5 billion raise. I mean, give me your read on this. What's the end goal here, and is it really appropriate?
I think the companies that don't have a business model are now picking Bitcoin Treasury as their business model, and I think it's going to end badly. As my grandmother would say, it's going to end in tears. There is not a really great business in buying Bitcoin, putting it into a treasury, and then selling stock against it at twice the price, although we've seen it, from Michael Saylor and his company. I think it's going to end very badly. Bitcoin is a fine store of value, but I think the way people are using it with combining it as a treasury is not a great idea. And the second we have a downdraft and it goes down to 60K again, which it will inevitably if you talk to the OGs in the crypto space, they all believe it'll come back down 50, 60, 70. This is going to cause a lot of problems in these companies that are using Bitcoin as a treasury. It's not a good idea. And in terms of the president's conflicts, he's a rule breaker. He bends the rules, and it winds up coming back in the form of lawsuits or him being impeached. So hopefully he doesn't do too much of it, because it would be terrible to have the entire positive aspects of Trump's presidency, M&A, a roaring stock market, trade, all these great things that he's doing, closing the border and having sensible immigration, all that agenda that he was put there for could absolutely be derided and just totally thrown off track if his family and he do too much of this crypto shenanigans, I'll call it. It's a really bad idea. It's distracting. The people in crypto don't like it. I know people in and around the administration don't like it, and he should pump the brakes on it and maybe have less conflicts of interest. But this is America, and as we say in America, no conflict, no interest. Every president seems to have some weird, conflicted grifting going on in the margins, often from family members, as we saw with Hunter Biden, or even going back to Bill Clinton. So this is how it goes in a free market economy like the United States, with the power of the pardon in the presidency. It's an imperfect system, but we'll get through it. And I just hope the people around Trump tell him maybe pump the brakes on the crypto offerings from his family.
Jake, I also wanted to pivot focus over to the Middle East as well. I know you've been talking about this on the podcast, and obviously off the back of the president's historic visit to the region, there is a lot of bullishness right now about the opportunities that this brings for investment links between the US and the Gulf. In the UAE, for example, we already see a $1.4 trillion investment corridor being announced. So what do you make of OpenAI launching Stargate in the UAE off the back of the Trump visit? This has been called a whole new framework for American technology overseas. Obviously, it also raises some eyebrows, perhaps even some questions about why the US would want to deploy such sensitive technology into this part of the world. What do you make of that?
Yeah, the Middle East regions, specifically the Kingdom, Saudi Arabia, and UAE, are going to be major players, and they already are, in capital markets, venture capital, private equity, and technology. They've got about 30 years to convert their oil wealth into something else, whether it's tourism, private equity, real estate. But I think what they're really interested in is technology. And if you look at any technology market that's boomed, the United States, China, and in, the Nordics in Europe to a lesser extent, you really need to have three things. You need to have capital, you need to have talent, and you need to have a great customer base. In the Middle East, we've got a ton of talent, people who've been educated in the West, a ton of capital, and some really great emerging customer bases. And the country is within, a 2-hour flight of Dubai, of Riyadh. It's a pretty significant number of customers. And having spent time there in the last 2 years, and we'll be active there with our firm starting in the fall with one of our programs. I haven't announced it yet, but we're going to be doing some entrepreneurial stuff there. I think when I meet the people there, they are not dumb money. They are anything but. These are incredibly well-educated, sharp, and motivated individuals, many of which have been educated in the West. And when I meet with them, I'm starting to see them not want to just put money into funds. They want to directly invest in companies. They want to start companies, and they want to be on the board of companies. This is a very sophisticated group of individuals with very deep pockets who are willing to make audacious bets. That's good for humanity, and I think it's important for this region to partner with the West, as opposed to maybe going east and partnering with China. That's my interest in spending time here, is I'd like to see democracy. I'd like to see a collaboration between this region and the United States, as opposed to maybe partnering with people in China.
Just expand on that for me. How do you see this ultimately reshaping the global AI map? And also, JCal, who actually gets to compete? Because we do see this increasing competition between the United States and China. It seems as if the Middle East region is all in on the US for now. Would you say that is the right strategy moving forward when it comes to investment and AI sovereignty?
Well, my bestie, David Sachs, is the czar of AI. He's been spending a lot of time in the Middle East, and you've got one of the sharpest minds in Silicon Valley, one of the great deal makers of all time from Silicon Valley, David Sachs, leading this charge for President Trump and with President Trump. And you have to ask yourself a very basic question. if $1 trillion or $2 trillion is going to be invested in AI, would you like it invested in American companies and in collaboration with American companies, or would you like it in collaboration with Chinese companies and the Chinese government? I have no problem with the Chinese people, the wonderful culture, wonderful people, but I do have significant issues and concerns with the Chinese government. And anything we can do to have the massive investment that the Middle East will make independently in their own judgment. They're not going to make those investments because America asks them to or tells them to. These are sovereign countries with very intelligent people at the helm of their sovereign wealth funds, and they're making the decision that America is the best bet in the world. And that's something you can give the Trump administration and David Sachs a lot of credit for. And ask yourself, do you want a world in which those companies make investments with Xi Jinping in a country that has reportedly 1 million Uyghurs in a concentration camp? I think I'd rather have these individuals investing with the United States.
So, J-Cal, on that, what about Humane in Saudi Arabia, another major announcement to come out of President Trump's visit to the kingdom? If you were a top engineer at OpenAI or at Google, would it be enough to convince you to move to Riyadh? It's something that the kingdom wants, right?
Yeah, I mean, the kingdom has been pretty clear that they're in a fierce competition with UAE and to a lesser extent Qatar for talent and for dominance in the region. So they will be recruiting talent there. This is one of the reasons why the United States has to be able to parse a very controversial issue in our country, immigration, and separate illegal immigration from recruitment of talent. We are in a global war for talent. And you know what? If you had your choice as a young person to go to Dubai, to Abu Dhabi, or to Riyadh, these are great places to live and to build a career. And people are going to be choosing between Europe, the Middle East, and the United States. And that competition is healthy. Talent will go to the Middle East. I'm seeing it with startups who say, you know what, I can get more investment, I can get customers, and I can get talent in the Middle East, and they're moving their companies to Abu Dhabi, to Dubai, to Riyadh, and they're being courted there by investors and by the government. And we have to think long and hard about that in the United States. Are we doing a good enough job recruiting people into the United States who are talented? But yes, talent will go to the Middle East. They already are going to the Middle East. It is a great place to start a company, absolutely, and it's a great place to go work, and it's a great lifestyle. Yeah, it's an amazing opportunity for young people. If I was a young person without a family and I was in my 20s, I would actually consider basing myself in Riyadh or Abu Dhabi for sure.
So this raises a really critical point, and I'm glad you raised it, because what we're seeing in the US now is a growing concern about brain drain. The administration has been putting a lot of pressure on universities, particularly over the last couple of months. Harvard being a case in point, one of the US's most established, most esteemed academic locations. Where do you expect the highest innovators and the future innovators to come from if the administration continues to push back on these well-established global institutions and places of learning?
You know, a lot of people in the United States no longer want to send their kids to the Ivy League. They want to send them to the University of Texas and places that are a little less woke, or maybe they feel supportive of ideas that are not aligned with their values. So I think the president is making a point to those universities, which he's entitled to do. Those universities have the ability to fund themselves and not take money from the government, or wait it out for 4 more years and then hope a different administration treats them differently. But that's how it works in the United States. We have a pretty cutthroat, sharp-elbowed process where the president can direct money and demand certain things of these universities. These universities can sue him back, which they are doing. In the middle of all that chaos, we have to remember that we are in a global war for talent, and places like Canada are more than willing to take a smart person for Dubai or Abu Dhabi and give them a golden visa, or Riyadh. They'll give a golden visa to these smart people. They'll pay for their apartments. They'll give them an incredibly low tax rate. So we need to be smart about the difference between recruiting the top 1% of thinkers and doers in the world and people coming across the border illegally with bad intent in our country. And that's something the United States has a bit of an Achilles heel on right now, a bit of an Achilles heel for. I'm trying to do my best on the All In podcast and in speaking, on programs like yours to say there is a distinct difference between illegal immigration and recruitment of talent. And let's, do what we need to do to shut the borders and have an orderly process for compassionate immigration for the refugees that want to come to our country. We can't take all of them. Obviously, no country can. But we should be recruiting, in my estimation, 1, 2, or 3 million highly skilled individuals into the United States. And I think we should be trying to have the United States become the most populous country on the planet in the next century. That would be a great goal for America. And we can do that one of two ways: having more babies or importing extremely talented people. We should be doing both.
Jason, just before I let you go, walk me through your focus at launch for the second half of the year. You're on the ground in Singapore. No doubt we'll be seeing you out here in the Gulf again very soon, I hope at least. What are you doing? Are you looking to raise capital? Are you looking to deploy capital? What's your highest conviction bet right now?
Yeah, so we are an investor in pre-seed companies, year zero companies, and year one companies. I'm quite famous, as you know, for being the third investor in Uber, and then also one of the first investors in companies like Robinhood and Thumbtack, DataStax, et cetera. And I've done very well trying to find those companies in year zero, right before they launch their products. And that's where I can do my highest work. We're deploying our fourth fund, which is a $45 million fund. We don't need a ton of capital to do what we do, but we have a program called Founder University where we have 20,000 people apply a year to come to. We accept about 1,000 of them, and then we invest in the top 10% of those. And so I'm trying to take this founder.university as the URL program around the world. We'll be announcing a Founder University in the Middle East next, and then who knows, maybe Japan, Australia, or Singapore will be the third location for Founder University. What we do in that program is teach teams of 2 or 3 highly technical people all the tips and tricks we've learned over 10 years and 400 investments of how to start a company, how to build a cap table, how to understand customers, obtain product market fit, just the technical blocking and tackling aspects of startups. So I appreciate you asking. And if anybody out there is interested in applying to Founder University and working with me and my team for 12 weeks to build a great company that changes the world, founder.university.
Okay, appreciate the plug. All right, Jason, we'll leave it there. Really appreciate the conversation, and thank you again for coming on today. That is Jason Calacanis there, General Partner
See you in
at
September.
Launch. Great conversation. Hope so. Looking forward to seeing you out here soon. Jay Cal there. And of course, we are keeping a very close eye on Japanese yields today, as well as the longer dated end of the yield curve continuing to surge. Interesting trade happening here. Lin joining us live now for a quick take on this. Lin, why are these rising yields being described as a canary in a coal mine?
Hey, Dan. Well, generally speaking, when we talk about longer dated yields, it is a reflection on investor sentiment on the outlook in terms of Japan's fiscal position as well as inflation position. So when you have these longer dated yields surging, it's clearly a sign that investors are asking for a lot more yield to hold that longer term debt. And that certainly raises questions around debt sustainability, keeping in mind that Japan is one of the most indebted developed economies, 260% or thereabouts in terms of debt to GDP levels. And so that's why it's been seen by many analysts as a potential early warning sign, not just for Japan's bond market, but global bond markets, because when we see a surge in terms of JGB yields, that then also has flow-on impacts in terms of potentially a sell-off in the US or in Europe as well. Certainly duration risk is global. In terms of what we've been seeing today, market participants watching very closely that 40-year bond auction, and the results are suggesting continued market fragility because we saw that bid to cover ratio coming in at just 2.2, so that's the lowest since November of last year. And this is despite, and you can see it in the chart here, that yesterday, we actually saw the yields dipping back because of these multiple reports that suggest we could be getting that support from the Ministry of Finance in terms of a cut to issuance. You've also got local media reporting that they could be looking at holding a special meeting of JGB primary dealers on June the 20th, which is highly unusual. Usually these sorts of meetings happen at the end of the year rather than in the middle. But certainly, Dan, this is a story to continue to watch.
We'll be following it closely. Lin, thanks so much for the update. We appreciate it. And let's get you a check on how Europe is set to open the trading day ahead as well. We are expecting European markets to follow the lead of Asia here. It's been a mixed trading day across the region, but for the European wake-up call, the Spanish IBEX called down around 2 points here. Germany's Zetrodax up by 43. The Paris CAC and London FTSE also expected to open stronger in just over 3 hours' time. That wraps up this edition of Access Middle East. Hey, thanks so much for your company today. I'm Dan Murphy in Dubai. Stay with us here on CNBC Europe Early Edition with Sylvia Amaro is up next.